2 and 4. That is okay for you people?
Yes,
Yeah,
sir.
yeah, okay.
That time is okay. So I think the only way of making up the lost classes is that we try to do something between 2 and 4 apart from 6 to 8. Then I think it can work. Otherwise, it will be difficult, I think. Tanya, Tanya is here now. So it's good to have all 4 of you here today. I think the other 2 have at some point or the other lost interest, because I think it has been almost more than a month now since we have seen them. Monica and Alice. Alice, I think, came in between. And
Good
then
evening.
after that, good evening, Tanya. Okay. So today's class, this is a class on investing in gold. So remember last time we were talking about alternate investments. So alternate investments are basically apart from the usual type of investment which we do in fixed deposits, equity, mutual funds, that type of investment. Apart from that, any other investment that we can think of, that is referred to as a alternate investment. So alternative investments, one we touched last time was real estate. And this time today we are doing gold. So this is a very interesting PPT. I'll show you some of the things which are there, which you'll understand the whole thing about investing in gold better. And there are some nice, little facts here and there, which you may find interesting. So I'll just go to the PPT now, and we can start with this right away. So let's look at some, basic facts and figures, about gold. So India has an estimated 23,000 tons of physical gold. So India holds almost 10% of the world's total gold inventory. I'm sure this is because of our culture of, having gifting gold during marriages, and it is the marriage itself is sometimes considered incomplete unless there is gold. The quantity of gold may differ from state to state, but broadly speaking, I think it holds true that gold is always something which is very important in a marriage. Then India is the largest importer of gold, and every year it imports 700 to 800 tons of gold. Now just imagine we are importing all this gold, and this gold is actually being used for mostly for consumption, jewelry. So that means that this, so gold, which people who when they receive gold during a marriage, I think most of our ladies, what they do is they keep it in the locker. So that is, you can say that that amount of capital is being locked away inside a locker, and it is actually not being put to any use. So this approach now is very, very different from the approach which is adopted in Western countries, where you do not find that they ever waste capital. Our country, we will keep it there in the locker. It will come out only during times of crisis. There is something to be said for that. अच्छी बात है कि आप जब परेशानी वाले दिन जब आते हैं, उसके लिए आप बचा के गोल्ड को रखते हैं, वो सब बात अपने जगह पर सही है. लेकिन ये भी फैक्ट है कि इतना सारा कैपिटल इकोनॉमी में एंटर नहीं कर रहा है. थिंक ऑफ इट दैट वे आल्सो. सो दैट इज अनदर थिंग. देन ऑफ कोर्स the amount of gold imported after the lockdown has been one of the lowest ever, obviously, because people, marriages itself were not being held. There was a general feeling of, I think, panic among the people. And as a result of that, this was not happening. And this last point, I don't think we should look at this very seriously, because this is almost true still. Gold prices are at all-time high right now, around 44,600 per 10 grams. These figures are a little old. It's a little higher than this now, because in the recent issue of sovereign gold bonds, the price of gold was 4,736 rupees per gram. So per gram, so that means 47, more than 47,000 for 10 grams. So these are some basic facts about gold. Now, why do we actually go for, why is a gold investment considered to be good? Paresh ji, you can start off the discussion here. Why is investing in gold considered to be something which is good?
It is considered as a safe investment.
It's considered as a
one of the reason, but we can't liquefy it. You can't sell at any time, because the prices are. We can see the variation in price, gold price, but compared to stock market, it is considered safe, more safe.
It's considered safe. And that is one of the reasons why, if the stock market is doing very badly, or the economy is doing very badly, then people tend to invest more in gold, because you feel better. You feel that this is a safer place. Gold, after all, is gold. It has a certain amount of value. How good it is as a form of investment, that we will see again. It is good. Let's not get away from that. But we'll actually see some figures a little later in some slides. Now, it is a hedge against inflation. What does this mean? Can somebody try to answer this? Shruti, what does it mean? What does it mean when we say that gold is a hedge against inflation? Hedge, the word hedge means it protects you from inflation. How?
Sir, the prices of gold tend to rise, and if we compare it with inflation, it is always higher than it. So I can say that.
Good. Very good. And the other, so the prices tend to rise, that is one. They tend to rise at a rate which is higher than inflation. And the other very good thing about gold is that you very rarely see the prices declining. Generally speaking, if you look at any graph of gold prices over a certain period of time, you will generally see that the prices keep rising. Then it is a store of value. That means whatever value that is locked in gold, that is physically there. it is basically already physically available there. It can be exchanged immediately for its equivalent in currency. So then there is instant liquidity. So if you have gold, it is possible for you to sell the gold. Like Paresh was saying, that it is possible that you will not get the price which you want. But I don't think you will ever find it troublesome to sell gold. So recently, during my son's marriage, whatever gold jewelry we wanted, basically what we had been doing is, over the last so many years, almost 20 years, we had been buying gold coins. We were buying these gold coins, and after 2019, there was a huge increase in the price of gold. So all those gold coins that we had collected, it was possible for us to, last year, just before the marriage, basically use these gold coins in exchange for the jewelry that we wanted. So cash was not touched. We immediately were able to use the gold coin itself. So the liquidity was not a problem at all. The other thing is, gold will tend to be less volatile. That means the prices tend to stay more or less stable. You don't see gold prices spiking to a very high level in a very short period, dropping down again, crashing like what happens in equities. And that is again one of the reasons why we consider that investing in gold is safe. Because anybody investing will see that his investment in gold gradually tends to increase. So that advantage is there. Then, of course, it is an excellent diversification for your portfolio. That means portfolio is a collection of securities which you have invested in. So, for example, you may have invested in some shares, a few company shares are there. You may have invested in mutual funds. You may also have put some money away in fixed deposits. It's also possible that you have some real estate investments. So these are four. Now a fifth type of investment which will add to your portfolio and which will help to make the portfolio even more rich in diversity is gold. So if you buy gold also, it will be another addition, a very good addition to your portfolio of investments. So this is another very good thing about it. And remember, this is a global asset class. This is not something which is confined to your country. Gold has a value anywhere. So like we say, it's a store of value. A gold of a certain purity will always be convertible to currency, whether you are in India, whether you are in Europe, America, the Middle East, anywhere. There are so many Hindi films which you have seen, gold actually being smuggled into the country. Back in the 80s and 90s, when there was a lot of restrictions on the export of gold, at that point of time, you have so many of these films, famous smuggler Haji Mastan, all these people, involved in basically bringing gold into the country from another country. So globally, it was exchangeable. They bought it somewhere else, and then they sold it in India, and they made a huge profit. Now look at this. This is basically a graph. So this is one of the slides which I wanted you people to see. So the historical price of gold in India in rupees. So basically all data out here, gold price is basically per gram, rupees per gram. So let's say we begin at around 1974, where it's very low, below 500. It stays more or less stable till 78. So you see, for 4 years, it is at this level. It's not zero, mind you. It's much more than that. The scale is, since we have compressed almost 40 years in this, so it is a little difficult to show the movement here. But broadly speaking, you can say that it was moving at this pace. In the 80s, it began to increase a little. And you can see that somewhere in the 90s, it is touching 500. And after that, you can see again, it very steadily, it stays in this 500 range for almost the next 10 years. And then it begins to increase. Roughly, you can say that somewhere around 2007, it is touching 1000. So it touched 500 here at somewhere around 1995, and somewhere around 2000, 5 years later, 2007. That means almost 12 years later, it reached this place, 1000. After that, you can see the rise has been a little steep. From this period onwards, you can see that gold prices have been rising steadily. Like I said, this particular graph is compressing 40 years of data into one page. So the actual movements from year to year are not that clearly visible in the graph. But you can see broadly that it increased like this all the way to 3000, which it reached in about 2013. Then it drops again a little, comes to below 2500 over here. And then you see it rises continuously till it crosses 4500. When this graph, the data which I took from a site called goldprice.com was taken on the 22nd of September 2020. I did not update this for the obvious reason that, first of all, there has not been a great increase in the price here. It is about 4,700 today. But you can see that, broadly speaking, if you take any 5-year period, you will find that there is a lot of stability as far as this is concerned. So I would say that have a look at this graph. This is it's an interesting graph. This is one. And next graph, the same data, but this time it is showing it to you from 2001 to 2019. And you can say 20, about up till 2020. It's showing you here. Now here you can see between 1 and 7, you can see that it has gone from 500 to 1000. Then from 7 to, you can say 12, it has gone from 1000 to 2500, even more than 2500. And then from 2500 in 12, it has gone up to 4500 in September 20 and 4700 today. So when I said that over the years I was buying gold, and when I reached this point, I sold the gold, golds at a little above this rate. So I was able to get a very good return on whatever I had invested over these years. So broadly speaking, you will see that it is a very, very reliable investment, and you never worry about gold. So you know that, but once again, like we discussed in the case of equities, and as we discussed in the case of land also, if you really want to unlock the value in gold, if you really want to make some money in gold, it has to be kept for a rather long period of time. If there is no shortcut here. One of the lessons which I hope you will draw from all these lectures that we've had is that whatever be the asset class, there is no shortcut as far as getting a high return is concerned. So that's one thing I hope all of you have taken note of, irrespective of whether it is a mutual fund, whether it's an index fund, whether it's a sector-specific fund, whether it is equities, or whether it is land, or whether it is gold. Over a long period of, yes.
So this sharp increase from 2008 in gold price, maybe because of share market was collapsed in 2008.
Yes, you're absolutely right. See, that is the year of the recession.
2008
is the year when the big crisis came in America. The whole housing loan crisis came. And at that point of time, that whole disease spread to all parts of the world. In fact, we in India were less affected. Only those people who are dealing with export-import businesses were more affected. We had not bought those bonds which lost value. But because of that, the banking system nearly collapsed. A number of banks actually collapsed in America, in Europe. And the government had to actually get behind these banks, bail them out, and find ways. So people began to get conservative, and I think they began to shift their investment to gold. That is why one of the words which you use is that gold is counter-cyclical. So if the economic cycle is going down, then gold prices will be going up. If the economic cycle is going up, then the gold prices will be going down, because the amount of money which is there in the economy is limited. The amount of money is limited.
So whenever people feel insecure, they buy gold.
Yes. Whenever people feel insecure, they will buy gold.
It's inversely proportional to share markets.
Exactly. It's inversely proportional to share market. And today, it is very easy to invest in gold. So it is not necessary that you invest physically in gold. As we'll see as we proceed with this PPT, it is something which it is possible to do the investing sitting on your laptop and having the benefit of everything that you do in equity, and also having the safety of gold. Both things are possible today. So it's like digital gold. So now look here, you can see the periods have been marked out here. So what you were saying, Pareshji, you can see it here. Global stock market crash of 2008. This period, there was a global stock market boom. So you can see that it was more or less stable. And then after that, it began to climb quite sharply. As things became a little uncertain, it has begun to climb. And here, easy liquidity policy of Fed, it will take too long to explain this entire thing, but just think of it this way. It became possible for big institutional investors to take money from America at less than 1% interest, and to take that money and invest in India. So when large amounts of money, millions of dollars, are invested in the Indian share market, the prices tend to go up. And if the prices go up, the gold prices will not go up. Remember, it is like Pareshji was using the word inversely proportional. So during this period, the stock markets were doing well, therefore gold was not doing so well. Here, the stock markets were not doing so well, so gold was doing well. Here again, the stock markets were doing well. You can see it says here that there was a stock market boom. So since the stock market was doing well, gold was not doing so well. And then over this period, there was uncertainty. As a result of that, you begin to see gold begin to do well again. Okay. Now, the next one is, this is again gold prices, but this time the returns are given. Gold returns in the past 10 years.
Hello.
Yes.
Yes,
Yes,
sir. Yes, sir. One query is there, sir. That last point, inverse relation between gold and share market.
Acha, you want me to repeat that?
That last point, sir, between 2011 to 11-12, there is a boom, and today also market is booming and gold prices are also booming. So how the relation?
I don't think gold prices are booming. Personally, I don't think that gold prices are exactly booming. It has been in this 4,000 to 4,700 range for some time. It's not, it's more or less stable. You see, what has happened is, in these what shall I say, these slides which you see, these graphs, when you compress the data for a number of years into one page, it is hard to see the stability there. But the fact remains that, see, this part here, this part where you can see that over the last, I would say at least, right now we are in 22. If you look at it today, even today, it is only 4,700. And this particular thing, it had reached 5,000, came down to about 4,500, and it is more or less at this level here only today. So, broadly speaking, see, it will not follow that exactly, Praveen. It will not follow that particular thing exactly. But I think that you will agree that there is not a very sharp boom, in that period. See, we are basically between 4,000 here and 4,500 here. This is the part. This is a very short period. This boom up to 5,000 and coming down. Otherwise, broadly speaking, we are in this period only. Just give me 1 minute, please. There is a phone which is down. Hello. Okay, now when you come to the gold returns over the years, so what they have done is, you can see that so these are gold returns over 10-year periods. Different 10-year periods, 10-year periods ending in these years. So 10-year period ending 2011, 10-year period ending 2012. Please look at it that way. As you can see that there are some 10-year periods where it is not so nice. It comes down. But that has only happened, I think, here at this point, 2014 to 2016, where in this period, the price of gold actually has not actually gone up so well, done so well. But otherwise, if you look, broadly speaking, you can see that it has done pretty well over the entire period. So 23, 31, 10.3, 0.8, 11, like that. So over this period, it seems to have done pretty well. And it just gives you an idea about how good this investment actually is. This is one. And the last 10-year period, the 10-20 period, it had grown by 29.3% over in this period itself. So this is just to give you an idea about the investment. If you compare gold and Sensex, 20-year returns. So like I said, these things you will always have to look at it in fairly long, over long span periods of time. So you see that there is something written here. Due to the recent abrupt fall in the market, Sensex has fallen behind gold in terms of returns. So if you look at this, what it says is that the value of rupees 1 lakh invested 20 years ago in gold, suppose you invested around May 2000. Then by May 2020, this 1 lakh would have become 10.61, 10 lakh 61,000 roughly by the by May 2020. May 20,000, you put in 1 lakh. By May 2020, you can take back 10 lakh 61,000. If you had put the same thing in the Sensex, suppose you put it in an index fund which had the Sensex as its base, and you put the money in May 20,000, by May 2020, you would have had 7 lakh 8,000. But please note, the Sensex is this gray line. Now, if you look at the gray line, it has gone up to a much higher level here, almost the same as gold at this point, but then it has fallen in May. It has fallen pretty steeply. So that means that if I take the figure maybe for 3-4 months before, then even Sensex is going to give you a similar return. See, because share prices tend to be volatile, the problem here is that the closing date that you take and the beginning date that you take, that begins to affect your returns. That point is there. But you can see that gold gave you a return of 12.54% over this period. Now that is the annualized return over this period of time, these 20 years. It comes to 12.54. And as you can see, that in the case of gold, it is quite smooth, the way the returns are happening. So this is another way of understanding the sort of returns that you get from gold if you keep investing for a long period of time. I have certainly been the beneficiary of this part. I have been able to invest during these years and been able to get back a fairly decent return during in May 20. This is May 2020 in my case. Basically 2021. 1 year later, I was able to sell some gold for the marriage, and the investment turned out to be good. So if you look at this long period, you get safety, no volatility, easy to liquidate, and you get a decent return. Consider that today, if you were to put your money in, let's say, the bank, you would hardly get any return. It is so low, it is eaten up mostly by inflation. So this is the advantage in gold here. If you look at gold versus inflation, in March 2011, the price of gold was about 17,000 per gram. The consumer price index stood at 85. In March 2020, the price of gold was 32,000, almost double, and CPI was 145. You get an idea about how it is providing you a hedge against inflation. So when we say that it's a hedge against inflation, it keeps pace with inflation. That is the important thing. This is another slide between June. I will not further take any time on these slides, but of course, I'll be sending these slides to you. Have a look at these slides on your own time so that you begin to get an idea about these gold prices. See, now, when you reduce the period to 1.5 years, so June 19 to January 20, and 1 year, sorry, over 1 year, you can see the ups and downs, the movements much better over this period. So you can see broadly that June 19, it is 2,900. It has gone up to 4,200. Praveenji, this particular increase that you are seeing here, what do you think is the reason for this? See, in my opinion, this is the COVID effect.
That is COVID effect.
This is basically the COVID effect. So people felt insecure, so they moved to gold, and that has seen the price rise. See, if you look at the Sensex today also, on a day-to-day basis, it is enough to give a big investor a heart attack. See, there is so much of volatility. The Sensex loses 500 points on one day, gains 300 the next, drops down 400 on the third day. It keeps happening day after day. There is so much uncertainty. Now you have the war with Ukraine and Russia. That is again creating a problem. Because of that, the oil prices are going up. And if the oil prices are going up, India's import bill begins to increase. And if India's import bill begins to increase, there is a general, fear of inflation, and hence people will move to gold. Now, one thing you need to understand is, how do you determine gold prices in India? One is the global price of gold. The thing is that the global price of gold is decided in US dollars. And the US dollar, there is an exchange rate between the Indian rupee and the US dollar. So if the rupee becomes weak, that also will push up the price of gold. That means it will take more rupees to buy 1 gram of gold. If the rupee becomes strong, it will take less rupees to buy 1 gram of gold. So these things are again another factor in the case of India, which will affect the price of gold. So this is another thing just to keep in mind. Now, the next thing here is, what affects the global price of gold? So the global supply of gold is approximately 2,510 tons per annum. That means gold is being mined in, let's say, in South Africa, in in some countries in South America. This gold which is mined ultimately enters the world market. So if there is a supply of gold of 2,500 tons, the same amount of demand is also there. That means more or less whatever is produced is sold. 55% goes for jewelry, 33% is for investment, and 12% for technical manufacturing. So these are the three places where gold is used. 55% for jewelry, I'm sure in that 55%, a large part is India. But gold jewelry is important everywhere. So it's not as if we are the only persons responsible for this part here. 33% is for investment and 12% for, so for investment basically means it will take the form of gold biscuits or gold bars or gold coins, all of which are not decorative items, but basically you are taking money and you're locking it away in a gold coin or a gold bar or a gold biscuit, whatever. So the liquidity policies of the large economies, US, this, I don't think we need to get into this detail here. Global economic conditions. So this still looks tough till we all get immunity and life gets back to normal. This is going to be a problem. But broadly speaking, these are the things which affect gold prices. So when we say liquidity policies of large economies, just to give you an idea, suppose the US reduces its interest rates. So you will find that as a result of that, more and more US investors will invest in India. They will take money at low rates of interest in the US and put that into the Indian stock markets. The moment that happens, the stock markets will tend to do better. And when that happens, there will be less investment in gold. So that will again have an impact on the gold price because it will tend to reduce the demand a little. That is one. This is another slide which I would like you people to have a look at home. This is basically the GDP. So this is not exactly critical for this presentation, but I thought you people should have a look at it. It's a 20-year snapshot of the GDP, and it shows you the rates at which the GDP grew over these years. So you can see it is 0 to 8. The highest we have had is somewhere around 2010, where it was around 9%. And then after that, it has gone up and down each year. Presently, it is in 2018, this was showing at around about 6%, 5%. Okay. So just have a look at it later. You'll see the way the country has performed over these years. Year to year is given here. Year to year, you can get an idea out here from these. Okay. We have been going downhill for 3 years before COVID. Already we were going down. These three red bars here will give you an idea. And then COVID, of course, created we will not actually look at these two. But basically what is written in these slides is that there is a relationship between inflation in the US, inflation in India, and the price of the US dollar. So as you can see, in 2015, for example, Indian inflation is 5.88, US inflation is only 0.7. So the Indian rupee is losing value by more than 5% when compared with the US dollar. So that will reflect in the exchange rate. So the price of the dollar will increase. Since the value of the rupee is more, you have to pay more rupees to buy $1. If the value of the rupee goes down, that will also have an impact on the price of gold. This is the basic point which you need to remember out here. Okay, and then so you can see inflation in the US last 5 years 1.82%, India 5.17%. Okay, this is another little thing here which we had put just so that you get an idea. So in 2015, the price of $1 was 66 rupees. It has gone up to 73.50 in 2020, and it is more or less in this range today, in this part. Okay. This point here, past 10 years, gold has performed nifty over 10 years. So you see, whenever you take these things over a long period of time, you begin to get better returns. That is the main lesson that we can draw from this. Now, let us look at how you invest in gold in India. After all, one of our main, the part of this presentation is this. And this is the one which is of most, what I would say is of the most importance to you. So physical gold, this is one way of investing. So you can buy jewelry, you can buy a bar, or you can buy a coin. Of course, we will not be able to buy bars. That is for big industrialists. For us, maybe a coin or jewelry. Then there are jewelers' investment schemes where you can keep on paying for years. This question is to Paresh ji and Praveen ji. Have you ever, any of you invested in this jewelers' investment schemes?
Yes, sir.
You have. So what is the rough return that they were giving you?
Sir, I think it's around 4.8 to 5%.
4.8 to 5%. Plus, if the gold price goes up, then you get that benefit also, I think.
Right.
I think you get a capital appreciation also. No? So,
sir, on an average, 4.8%, not more than that.
4.8%.
Yeah.
Okay. So this is another way of investing. I remember last year when I was buying some jewelry, at that point of time, I found that this sort of scheme was there in many of the jewelers in Pune, where they encouraged me to, like deposit money with them on a regular basis, in return for which they would give me a discount on any jewelry that I bought later. So that's the jewelers investment scheme. Then, of course, there is so this one here, this physical gold, this is also like a physical gold only. The only thing is that you are paying for it in parts, in installments. But then you come to the gold exchange traded fund. So anybody on this? Shruti, Tanya, ever heard of this ETF in gold?
Sir, no, sir.
Okay, Tanya, doesn't matter. You learn about it today. Shruti? Paresh ji?
Sir, I heard about it, but not knowing in details.
So it's just like a mutual fund, basically.
Hello.
Where the price which you pay is linked to the gold price. And then, of course, there is the sovereign gold bond scheme. So we'll look at these two now, the last two. The last one here, gold monetization scheme, we will not look at this at all because this is not something which is there on a regular basis. So the possibilities for us are either physical gold or gold ETF. And at the end of this, you can decide which one you will prefer. Now, if you go for a gold exchange traded fund, so basically this is a simple investment product that combines the flexibility of stock investment and gold investment. So, and the simplicity of flexibility of stock investment, simplicity of gold investment, both are combined. So they are traded every day just like a share. You can buy here. So they are based on gold prices. Whatever money they take from the different people who are investing in it, that is put in gold bullion. And there is complete transparency in the holdings because they will simply take the money, they'll put it in gold, they'll tell you exactly where they have put the money, and it is absolutely very low expenses from the point of view of the fund manager, because he doesn't have to choose, between different equities or something. He is just taking the money and putting it in gold. That's all. So if you look at this, I've given you about 10 mutual funds out here. All of them are listed on the National Stock Exchange. And you can see the launch dates out here of these different mutual funds. They are there today also. So you basically enter it just like any other mutual fund at the NAV. Whatever asset value they are giving, you will enter at that rate. That asset value is determined by the price of gold. So since we say that gold is not volatile, therefore the investment in an ETF will also not be volatile. It will not go like this. It will be more or less steady. That's one thing to remember. The other thing is you are getting the benefit of gold without the safety, the problem of being a custodian of the gold. You don't have to safeguard any physical gold. But at the same time, the digital certificate that you have, which allows you to keep that, which tells you the amount of holding that you have in the ETF, that is as good as gold. So you can think of it as digital gold. Are you getting this? Any doubts here? You're clear, Parejji? Shruti?
Yes, sir.
You're clear, no? So basically, you will invest here.
So I have one question.
Yes, Parejji.
Oh, sorry to disturb you. Sir, if we invest in this ETF, so we have to pay charges, fund
very
management
small,
charge. What we can say?
It's a very small charge. So, and suppose you bought it physically, then in that case, you would have had to keep it in a bank locker.
Right.
Then there'll be a charge there also. Apart from that, when the time comes to sell, you have to go to the bank locker, take it out, go to a jeweler, and then hope that he accepts the gold at the purity level you have claimed it to be. So there are issues here. Here what happens is, for that low charge which you pay, you are getting all the benefits of gold. And as the gold prices rise, you will get that benefit. So in my opinion, if you want to diversify the investment, it is probably the best thing for you is to invest in gold. You already have, let's say, investments in shares, you have investments in mutual funds. In here, you have the chance of actually investing in gold without the problem related to gold, the problem of safety. Tanya, did you understand?
I think second advantage is that you can sell this ETF very easily because you are not attached.
Yes, it will sell just like a share now. It is as easy as selling a share. So just like in the case of a share, you are selling it immediately. Here also you sell it immediately. And in the next day, your account will be credited. So there is no problem at all. And it can be done with any of the online broking firms. Any online firm which is giving you a trading facility where you have a trading account, they will also allow you to invest in a gold exchange traded fund. So these are very safe investments. Tanya, did you understand this?
Yes, sir.
So you think of it, Tanya, like a mutual fund.
Yes,
So
sir.
when
Yes.
Sir, I have another question. Gold prices are there is no, if there is no fluctuation in gold prices, then this what we can say, ETF may have NAV. Na? So NAV of all these ETF should be same, right?
that is, I am not very sure about this point, because these guys, they buy and sell in bulk. They buy and sell in bulk, and exactly, some of them may get some benefit somewhere, some may not get something. See, one very big thing is that if the gold price is going, let's say there is a slight variation. When you start your investment, you will change the return that you get. If you started off at a point when the gold price was slightly lower, then you will be slightly different from the other person. So there will not be a huge difference, but broadly speaking, it will depend on your timing. So people who are quitting your investment, if they quit at a very high rate, and then you are forced to buy again at a high rate, so the proportion of gold bought at different prices will be absolutely different for each partner. Suppose both of us invest in gold, Paresh, but we invest in different times at different prices. Then the value of our investments will also be different.
Sir, that is okay, but NAV of this, ideally it should be same.
No, why will it be the same? The NAV will not be the same because your pricing is different. So what will happen is that at the end of the day, how much of, like the total assets that you have, see, how do you calculate NAV? You take the total value of the assets that you have and you divide by the number of units. So that will be different for different people. It will not be exactly the same. Because the price, what you have paid for your assets is what makes the difference. Now, you may have paid more for your assets, you may have paid less for the same amount of gold. That is going to make a difference in the actual amount of the per unit cost. Later on, we can, try to take this and take a practical example and see how it works. But you can take my word for it, it will not be exactly the same. The value is going to be different for different people.
Yeah, possible, but maybe not much difference.
Yes, that I'll agree. It can't be very much. That there is no doubt about that. But it will be different. Then let's look at it like this. So investing in exit is convenient. There is transparency in pricing. Why? Because it is linked to the gold price itself. So there's no bungling in the pricing. It is affordable as you can buy in units representing 1 gram of gold. So basically what this means is that your minimum investment will be around 4,500 rupees today. If you were doing this 10 years before, then maybe you would have been investing only around 2,500. There are no issues of purity. That is not your headache at all. No storage issue. And it is tax efficient in the sense that there is no sales tax or wealth tax on gold ETFs. So this is another thing. So when you actually liquidate your investment, sell your gold, there is not going to be a sales tax there. So you are not actually in any way losing at that point. Then we come to the sovereign gold bond scheme. Now, in the sovereign gold bond scheme, remember, this is a scheme which the government comes out from time to time. And the RBI administers this on behalf of the government. But basically, this is not always available to you. This will only be available to you when the government actually comes out with the scheme, like they had done this last year. So when they did this last year, it was possible for, not last year, sorry, this year itself, in January. This year, January, they did this. So if anybody wanted to invest, there was a 10-day window in which they could have invested in this. Now, broadly speaking, see, this is an advertisement. It's an older ad, but it gives you an idea. Earn 2.5% interest per annum on investment value. Special discount of 50 per gram on online investment in sovereign gold bonds. And you will also get the capital appreciation benefit. So let's look at this in detail. You pay rupees, you get a gold bond in digital form under the scheme. First step. Bonds are issued and backed by the government. The value of the bond is equivalent to 1 gram, 5 gram, 10 gram, 50 gram, and 100 grams of gold. This is one part. Price of 1 gram of gold for an online investor is 4736 today. So if you're not doing it online, if there is some other method you are adopting, then it is going to be 4786. Then an individual can buy up to 4 kilograms of gold. This is a change from the last gold bond scheme, when it was restricted only up to 500 grams. I think the last one was around 2 years ago. They have changed that. But the interesting thing is that in the last one, this price was more or less the same. So the point I'm trying to make is that there is a certain amount of stability over short periods of time. Okay, then the bonds will carry a rate of interest of 2.5% in the current scheme. This was also the rate during the last scheme. The bonds will be for 8 years with exits possible in the 5th, 6th, 7th year, as well as just like you can take the bond, give it back, you will get your whatever the number of grams of gold that you had bought at the prevailing price of gold, 1 gram of gold on that day when you sell 8 years from today, you will get the benefit of that, you will get that price. So in these 8 years, if there has been an increase in the price of gold, you will get that benefit immediately. Apart from that, you're also getting a 2.5% interest every year. So those are some benefits there. If you want to exit early, then from the 5th year onwards, it will be possible for you to exit. So you can exit in the 5th year, 6th year, or 7th year. 8th year, in any case, you will be selling the entire bonds back. It will be redeeming the bonds. At the end of the tenure, that means at the end of the 10 years, you will be able to visit a post office or bank, redeem the bonds for the price of gold on the day you redeem. Whatever it is, whatever is the price on that day, you will get that price. So you will know exactly what you're going to get. You can use the bonds as collateral for loans. This is another advantage. You can take the bonds and you can go to a bank and you can take those bonds and you can pledge those bonds to the bank. It is possible to do it digitally. And then in return for that, you can take a loan from the bank. Suppose you need the money desperately in the 2nd year itself or the 3rd year itself. Then it's possible for you to do this. That is another thing. Then the bonds will be tradable on a stock or bond exchange. This advantage is also there. You can also take the bond and trade it in the bond exchange. Maybe you will not get the price that you want. So that issue is there. You will have to think about it. Is everybody clear about this?
Yes.
Okay. So these are the different options that are open to you for investing in gold. These are some more details. KYC norms will apply. You have to give proof. Capital gains will be like gold itself. 3 years and above is long-term capital gains with indexation if you transfer the bond before maturity. Indexation simply means that whatever capital gain there is, that is set off against the inflation that has happened during that period. So you take the capital gains, find out the annual increase amount, take the inflation for the same period, you minus one from the other, whatever is left, that amount will be your capital gains. There is zero tax if you hold to maturity, but the interest is taxable. So that 2.5% interest that you are getting, that is taxable, but there is no tax on the main part, the actual capital part of the gold. So these are the benefits. Essentially, you have 3 ways of investing in gold. The first way would be physical. So that could be jewelry, or it could be in the form of biscuits or gold coins or something like that. The second way could be through a gold ETF, which is like going for a gold mutual fund. This is the one which you can do anytime. Those gold ETFs are there. You can do this anytime. You can check up the NAVs, see which one you want to do it at, and that's it. And this part, what Paresh ji is saying, one thing he's saying absolutely correct. If I were to buy a gold, let's say, enter a scheme today, it will be at the price of gold as it is today. That I doubt if that part is wrong. That he is absolutely correct. The assets under management will be different. The actual profitability of the fund may be very different. But when you enter, probably the price at which you enter could be the same for each. I think we need to check this. Over the next, let's say by tomorrow, let's have a look at the NAVs of some of these different funds and see exactly where they stand. I think we'll get a good idea, because Paresh ji, I think, has raised a valid point there. We can have a look at that, maybe on our own time. And tomorrow, if you want, we can compare what we found. So look at those different schemes, look at the NAVs, and then let's see what happens. So that is that. And the third way, of course, would be to go for a sovereign gold bond scheme. A sovereign gold bond scheme, like I said, this would be possible. If somebody is trading it, then yes, you can do it there on the stock market, or you can wait till the government actually comes out with a sovereign gold bond scheme and you invest for that. But like I noticed last year, it was only there for around 10 days. This year only, sorry, January. It was there for a very short period of time. It came and then it was like it came and it went. If you are not alert, it would be gone. But one thing I did notice, you could invest in this through Zerodha, you could invest in it through Kotak. It was possible to do the investment through most of these trading portals. So that advantage is there. Investing is very easy. Quitting is very easy today for both sovereign gold bond scheme and for the gold ETFs. So remember, when you actually disinvest, when you redeem the bonds, you will get rupees. You will not get gold. Let's not confuse this. The entire transaction is being done digitally. You are transferring money through your bank account. You are getting it back in your bank account. It's that simple. So this brings us to the end of this unit. So we've covered alternate investments, real estate and gold. We also covered the other types, mutual fund, equities, debt, and all that. So after this, let's take a short break. If there are any questions, welcome. Anybody has any questions here?
No, sir.
Okay.
Actually,
then
sir,
in that
we
case,
need, hello.
Yes, Paresh.
Praveen here, sir.
Praveen.
Sir, we need notes on that RERA other investment. We have not received it, PPT. So can you forward it, sir?
I'll send it to you.
Okay. Thank you.
Real estate and this gold, both I'll send it to you. Okay. Okay, so that will complete your alternate investment. Okay, and let's take a 5-6 minute break, and then I'll come back and we'll start the next unit on financial statements. So financial planning part, which we covered all over the last more than a month, I think that part is over. So now we are getting into financial statements, working capital, that sort of thing. That other part of financial management, which is, I think, equally is very basic, very important, and which will help you in investing. So we'll take that next, and I'll be back in about 5-6 minutes. It's 7:05 now, so say around 7:10 I'll be. Okay. So let's start. So far, last 1.5 months, we have been basically doing things which are, I would say, simpler by financial management standards. They are definitely simpler and easy to understand. Also, it's very easy to see the utility of something like insurance or investing in equities or mutual funds. These are all things where we feel that it is easy to, what shall I say? It's easy to understand the concept, and it seems to be very useful. Now, in the case of financial statements, you sometimes feel that this is something about which you do not need to really know. ठीक है, ये कुछ होता है फाइनेंशियल स्टेटमेंट्स, लेकिन इसकी बहुत ज्यादा जानकारी रखने की जरूरत क्या है? ये अपना बोरिंग सा चीज है, इसको करना नहीं है. But what I would like to put before you is that if I am going to do any investing, particularly if I am going to invest in equities, remember we were talking about fundamental analysis, then it is good to have an understanding. Number two, whichever company I work for, if I can interpret the financial statements of my own company, then I will be able to understand the financial health of my own company. And for that reason, also, I feel that, spending a bit of time and attention and focusing a little on financial investments can be very, very helpful. These are the two things that I have to say about this. Other thing is that you will have to make a bit of an effort to, you'll have to remain a bit attentive and ask questions wherever you feel that you don't understand something. That will make things better. And if you interact in this session, I think the last session was very nice, where lots of questions are being asked, and it was good. If something like that can happen for this part also, I think that will be very, very helpful. So, what are the things that we want to cover? A basic introduction, understanding financial statements, talking about the main three financial statements: balance sheet, profit and loss, cash flow. Then a bit of ratio analysis and a bit of benchmarking. And then apart from this, there are some other things which you will find important. If you have your laptops with you, then let's see if we have time for that today. Opening an Excel sheet will be helpful. So in fact, tomorrow what I think I can do is, I will send you an Excel sheet which you can download from WhatsApp, and we can use that Excel sheet as we go along, the discussion. So first of all, when we say financial statements, these are the three main ones: balance sheet, income statement or profit and loss statement is the same thing, and cash flow statement. So right away, let us be very clear. These are the three main things that we are talking about. Apart from this, there is also something called an auditor's report, and there is something called a director's report. Those two also give you a very good idea about how a company is actually performing. So let's just keep this in mind right from the start, that the three main statements that we are talking about will be the balance sheet, the income statement, and the cash flow statement. We've said this before also, saying it again. The next thing is that, see, different stakeholders look for different things in the statements. The financial statement is there. But when I look at that financial statement, depending on who I am and what my relationship is with the company, I will be focusing on that part of the financial statement. For example, if I am a lender, that means I have given money to this company. then I am going to look at the ability of the firm to make payment on time. So if I look at the financial statements over a period of time, and I began to see exactly what the level of creditors are, what the long-term borrowings are, I look at all these things, I begin to get what are the interest payments that the company is making year to year, what is the profit that it is making. I begin to understand this part. Is the company actually being able to pay on time? First thing. Now, a creditor looks at the performance of the company to see if it is safe to give credit to the company. So, you may think that lender and creditor here refer to the same thing. Technically, yes, but let us just try to distinguish between a creditor here is basically someone who is selling goods to the company on credit. Let's think of it that way. Lender is a person who is giving finance to the company and for interest, and which normally will be for a period which is longer term period. The creditor, of course, is going to give it for a very short period of time. But when a creditor gives, let's say, a credit to a company, he has to be sure that the company will pay him back. So basically, the creditor is delivering some goods to the company, something which the company had ordered, and the company is not paying for it immediately. Over the next, let's say, 30 days, 60 days, depending on how much faith the creditor has on the company will repay it back. So the creditor also needs to understand from the financial statement whether it is safe to give the goods on credit to the company. Now look at the shareholder. The shareholder is most interested in the earnings figures. What the company that I have invested in, is it actually making money? Is it actually, like earning a profit? If it is earning a profit, it affects that shareholder basically in two ways. Number one, it is likely that he will get a dividend. So the dividend part is one. What is the other one? Shruti, anything? Very quiet today. Tanya? One thing that the shareholder looks for in the profit figure is, if the profit is high, then there is a chance that he will get a good dividend from the company. Correct?
Yes.
What is the other thing that can happen if the profit is good?
Share price will increase.
Yes, Paresh. If the profit is good, then consistently, if the company is doing well, then over a period of time, the share price will also increase. So for the shareholder, even more important than the dividend is the share price. So that's the next thing to remember. Now you look at a union leader, somebody who is, let's say, the leader of the union in the company. Now this person is interested in the financial performance so that he can make his demand accordingly. If the company is doing very well, obviously the union leader will say that let the company pay higher wages, give us more bonus, do something so that some of the profits are diverted to the employees. So for that union leader also the profit figures become important. And if you look at an analyst, somebody who is expected to analyze the performance of the company, for him the financial statement is bread and butter. He has to look at each and every aspect of the financial statements and understand each and everything. Is the firm being able to pay its debts? Does it have too many debtors? Is it selling too much on credit? How well is it utilizing its assets? How good is the management? What is the market share of the company? How is this company vis-a-vis other companies or in the same industry? All these things are going to be looked at by the analyst. So you can see that different people are looking at the company in different ways. Broadly speaking, all of them want a healthy company. but maybe the focus will be slightly different for different people. That is one. Like, for example, the lender, the banker, for example, is very interested in the long-term borrowings of the company. The creditor is very interested in the short-term borrowings. The shareholder is interested in the profit figures, because the profit figures have an impact on dividend and price of share. The union leader, the overall good performance, analyst wants to know the truth. He wants to basically understand the actual working of the company and relate that to the share price. Is the company undervalued? Is the company overvalued? Should the share price be much more than this? Today it is at a lower level. Buy it. Or is the share price already too high? Given the performance of the company, is the share price already too high? So there are so many things different people will be considering. Now, the other thing was, this is something which I had touched upon in the introductory lecture, the difference between expenditure and expense. Does anyone recall this? Paresh ji, I think you were there. Tanya, you were there also. Shruti, Praveen, I think all four of you have listened to this. I just thought that I would again remind you of this, since we are now hitting this chapter again. Profit is equal to income minus expense. Remember, not expenditure. So expenditure is like this: assets, expenses. Can someone tell me what difference we are drawing here?
So expenses can be called as liabilities?
No.
No, okay.
Not like that. See, asset is you are buying something which will generate income in the future. For example, you buy a machine, okay, or you buy in today's world, you buy software. You use the software to earn money. You use the machine to produce goods and to make money. So that is an asset. Expenses are for items that are consumed. For example, you buy raw material. You buy raw material, you pay wages, all those things. So let's say that when you pay an employee, the employee is giving you 1 month of service. So the amount which you have paid him, that is consumed through the service which he is giving in 1 month. You are basically paying him for the service. If you pay someone for conveyance, then whatever, he takes a car, he goes here and there, whatever you pay him is consumed because of the amount he actually travels over the period of 1 month. Let's say we are talking about 1 month. If you buy raw materials for production, if you pay electricity bills, water bills, anything, all these are actual things which are consumed so that the company can produce something. So nothing is left. An expense is you pay something, you get something, that whatever you get, whether it is labor, whether it is raw material, whatever it is consumed immediately so that something can be produced. In the case of asset, to buy a machine, there will be an outflow of money. You will have to pay for the machine, so there will be an outflow of money. Therefore, an expenditure has taken place. But the asset is not consumed in 1 day. The asset is there. It may have a life of 10 years. And over those 10 years, this asset will be used to produce something. And that will be sold. And when that particular item which the asset has produced, which the machine, let us say, has produced, is sold, then that sale that you are getting is your income. Is Pareshji, are you clear on this?
Yes, sir.
But now, when you say liability, the liability is the source of fund. Always try to remember this. Whenever we say liability, it is the source of fund. For example, the shareholder, the equity capital which the company gets, that is a liability. That is the source. The loan that a company takes, that is a source. The credit that the company gets when it buys something in the market. It has not paid yet. It has just bought the thing and it has to be paid in the future. That is again a source of fund. So any source of fund, just ask yourself this question, is this a source of fund? If it is a source, then it is a liability. An asset is always or an expense is a use of the fund. Where did you get the money to buy the asset? From the liabilities that you have. Why are they called liabilities? Because the company is responsible or liable for paying it back to the person from whom he took it. So even when the promoter gives money to the company is expected to pay back the promoter through profits. When a shareholder gives money to the company, when he buys shares of the company and the company receives funds from the shareholder, it is expected to repay the shareholder through dividends. So when a banker gives money to the company, these are all liabilities. It is expected to give back the money to the bank and also to pay interest. So these different sources of liabilities are there. Those funds which the company gets, that is used for expenditure. Some of it goes for creating assets. Some of it goes for the working capital side, the day-to-day expenditure side, the raw materials or the labor costs or the consumable cost, any consumable, that will be expense. So always remember, profit is equal to income minus expense, because we are not considering the amount spent on purchasing assets. Profit, we are only considering that part which was consumed to produce the finished goods. That's all. We are not interested in that amount which was used for capital expenditure. This you have to be very clear about. Tanya, are you getting this? Yes, Tanya?
Yeah.
Praveen ji?
Yes, sir.
Okay. So please remember this part. This is important. Now, in the balance sheet, we have liabilities, what I was just talking to. We have assets. Now,
So sometimes
yes,
your voice is not coming properly.
okay. What about now? Is it okay now?
Sir, no, it's okay, sir. In between, sir, it was very. So I think there
Which
was
part? Which point? Which part?
just before that, sir. When I was saying yes to you, when you asked me, no.
Okay, fine. Okay, chalo, I think it may have been a temporary thing.
Yes,
Otherwise,
sir.
okay. So in the balance sheet, the two items will be based around liabilities and assets. Liabilities, like I said, are all sources of funds. Assets are uses of funds. Now, profit and loss account, we'll be talking about income and expenses. So basically, this is how we actually look at it. The other side is, if in accounting, you will always have a debit and a credit. So asset is a debit because something has come in. You paid cash to buy the asset. So cash is credit, asset is debit. Similarly, expenses are debit. Expenses are debit, and whatever you bought with that, that is credit. So you can think about that part there. We will not get into too much detail with that. Let's just have a look at the balance sheet. So the balance sheet is a statement of assets and liabilities as on the last day of the financial year. So the first thing to remember in the balance sheet is that you will have to think that it is the position as on one day. It is not about the whole year. After all the year's activities, as on the last day, where does the company stand? What are the position of its assets and liabilities? That is one thing. The second thing you need to remember is that both sides will always balance. You cannot have a balance sheet which does not balance. Then the total of the assets will always be equal to the total of the liabilities. That's the second point which you need to remember. So the accounting equation is asset is equal to outside liabilities plus owner's equity. So outside liability is basically everybody who has given money to the bank. That means essentially these will be the debtors, the creditors, the people who have given money to you, the long-term creditors. And the owner's equity is basically the promoters, which the money which they have actually brought to it, the shareholders who have the people who, the entire shareholder part is here. And everybody else, the people who have given loans, etc., are here. This is the total amount of money which the company has. Like I said, this amount is used to create the assets. So the assets are the use to which these funds have been put. That is the thing to remember there. What are assets? Assets are resources that help the company to generate revenue in the future. So the easiest way to think of this is the machine which a company has. In the case of a service enterprise, the computers that that particular service enterprise has, the software that it has, these are the assets, number one. Then the assets, what are the examples that I gave you? Machines, software, patents, computers, anything that can be used to generate income. If you have a machine, you will use the machine to produce some finished good, you will sell that. If you have a computer, you will use that computer to give a service to someone, that someone will pay you for it, that will be your income. So how do we fund the assets? We fund it from the liabilities. So liabilities are basically obligations to repay money or render services in the future. So if somebody has given you any money at all, you are liable to pay it back. That is the basic thing. And that is the source of your fund. On the other hand, if you have received anything in advance, then you have to render service in the future. That means you will have to give that person, suppose somebody, you are selling, let's say, let's say you are an expert and you are giving, you are helping people to process their income tax returns. Let's just take a simple example. Some company comes to you and they say that, look, you have to process our entire returns. They pay you a certain amount in advance. You receive the advance. Now, over the next 1 month, you will be processing the entire income tax returns of that particular company. So you are rendering service, you are giving it service. Why are you giving service? Because you have received an advance. The advance that you have received is a liability. It is a liability because you are expected to do something in return for it. So when somebody gives you, let's say, a loan, you are expected to repay. You are expected to earn that money and repay. When somebody gives you an advance, you are expected to give that person the service that is required. In the case of a manufacturing firm, if let's say one of your buyers gives you an advance, what is your responsibility? You are expected to give him whatever amount he has ordered within the time in which he is expecting to get it. That is what is expected from you. So whenever you receive something from someone, you are expected to give something of equal value back. to that person. Therefore, it is a liability. Examples of liabilities, we will look at it more closely here. So, liabilities, sources of funds, assets, application of funds, or uses of funds. Now here, capital. Let's say the capital of a company, the equity capital, this will include the capital which the promoters had brought initially and the capital which the other shareholders also contributed. Then, apart from this 500, let's say the company still needs more money. It borrows this, let us say from the bank or through bonds. Then in that case, that amount can be considered to be the long-term borrowing. Now this part here, this rectangle that we have here, this is basically the long-term liability part of the balance sheet. Are you getting this, all of you?
Yes.
So Paresh ji, you can see that whenever we have the word liability, we are looking at this type of thing. Where am I getting my money from? But you just have to ask yourself this question. Then there are some liabilities which are related to the day-to-day running of your business. So this liability is given to you for a long period of time. So when when you buy a share in let's say in the IPO of a company, you are giving that your money to the company, getting a share for a very long period of time till the company actually exists. If a bondholder gives money to the company, he is giving it again for 7-8 years till the bond matures. If a banker gives it, he is once again giving it for 4, 5, 6 years, long periods of time. So those are the long-term liabilities. But some of the bank loans are given only for 1 year. Those are known as cash credit. It's like a drawing account. The person can take money. Every time he makes a sale, he will put the money back. Again, he will take, so it revolves. Take, repay in the same account. It will keep going on and on. So since it is for 1 year, it is put in the current liabilities part. Any money which I receive, which I have to repay within 1 year, I will call a current liability. Bills payable. I have bought goods from someone. I have not repaid that person. So I am liable to repay that person within the time which he has given me. This time could be 30 days, it could be 15 days, it could be 60 days, depending on whatever is the norm. So in every trade, there is some norm. In every trade, there is some norm. As per that norm, there will be a payment which you have to make. So that is one. Taxes payable. So there are certain taxes which you have to pay. So since you have to pay it, it is a liability. That's another one. Salaries have to be paid. There are people working for you. Interest has to be paid on the borrowings that you have taken. Rent has to be paid for the place where you are staying. Dividends payable. Maybe there are some dividends related to the last year which you have not been able to pay. All these are liabilities, because ultimately this money you have received, or you have received goods, or in the case of salaries, you have received labor. You have received something. So in the case of cash credit, you have received funds from the bank. In the case of accounts payable, you have received goods from, let's say you have bought raw materials. There is something you have bought here. In the case of taxes, it is payable by you. Government wants this money, wants you to pay taxes. That is the law of the land. Therefore, it is payable. In the case of salaries, you are getting service from your employees. Therefore, you have to pay. It is payable. In the case of interest, you have taken something from the bank, some money from the bank, for which you have to actually pay interest. Rent, you are staying in the premises, you are using those premises, therefore you have to pay. So basically, This is what the dividend payable is, essentially dividend related to the last year, which for some reason could not be paid. So therefore, it is still there with the company and it will be paid in due course. Okay, now look at all this money which the company got. Look at the long-term part, this rectangle, and compare it with this rectangle. This particular money, as you can see, 1,500 was long-term. Out of that, they spent 600 on land and buildings, 200 on machinery, 10 on office equipment and furniture. And they put investments in other companies, they put 90. So 90 plus 10, 100, plus 2, 300, plus 6, 900. So out of this 1,500, more or less 900 the company used for these different purposes. It still has 600 of the long-term money available. See, the advantage of this part, this long-term borrowing is nobody is going to ask for the money tomorrow. They will only ask for the money when it is due. And since it's a long-term borrowing, the whole amount will never be due in one shot. It will be due in installments. In the case of equity capital, it is never due. You don't have to pay this back at all. Somebody who has invested in your company, if he wants to quit, he can sell his share to somebody else in the share market. The long-term borrowings you will repay, but you will repay as per the repayment schedule, which will be staggered over a long period of time. So this money which they have out here is a long-term thing. People are not coming to ask for the money immediately. Out of this, they have used 900 here. Other 600 is being used to some extent over here. See, current assets, some amount is lying in cash. They have bought 450 of inventory. They have bought bills receivable. They have sold some goods on credit. So just as they received credit here, these accounts payable, they bought some goods and they did not pay. Similarly, they have sold some goods for which the buyer has not paid. So like I said, in every industry, you have to give a certain amount of credit to your. It's not possible for everyone to immediately have the cash to pay you. If you become very strict and say that no, will not give any credit, then you will not be able to make sales. Even if your quality is good, if the goods are really good, even then it's difficult for everybody, all your buyers, to find to pay. Therefore, it's necessary for you to decide how you can, whom to give credit to and whom not give credit. But some of the buyers to be given credit. That is the this part, tax refund receivable. So you've been informed by the tax department that we will be refunding 25 to you. So these are the current assets, because all assets are long term. This cash will be used in 1 year. The inventory will be received in 1 year. The bills receivable mostly will be 1 month. Asset is going to change a lot in the next few years. So this is one. Now, if we look at the total in both cases, it is going to be 1625 both sides. So this is the balance sheet. Now let's have a look at the income statement. So income or revenue is the amount of income generated by the business. So remember, income generation comes from sales. So whatever is the sales figure, that you can say is the income. So a company will generally have two types of income. The main income is going to come from sales. For a manufacturing company, it will be the finished goods. For a software company, it will be the services that it is giving. So proceeds of its software programs, license fees for using the software. So for example, when we use Microsoft Windows, unless you are using a pirated version, you are expected to buy Microsoft Windows. So when you buy Microsoft Windows, they will give you an annual subscription. And when they give you an annual subscription, you pay money. So when you pay money, it is a sale for Microsoft. That's one way of understanding it. Company is the sales proceeds of the good that it stocks. You're going to Reliance Mart to buy something, it has all those different types of goods available in the shop. It sells those goods. So as it sells those goods, that is income for it. From that, of course, they will reduce the expense and you will end up with the actual profit that it makes. So income is not profit. Net income or income less expenses is equal to profit. This is the point which you need to remember. And please note, we are not saying expenditure, we are saying expenses. This is the important part here. Next, expenses on day-to-day operating expenses are recorded in the profit and loss statement. We are not recording the big expenditures like the ones on assets. We are not recording those things in the any capital expenditure is not recorded in the loss statement. In the we are only writing about those entries which relate to the day-to-day running of the business. The assets are already there. That is not coming here. Here, whatever we are selling, we are writing about that. We sold, so we got this money. That we paid all these are my expenses, I record that. So be very clear, if you buy a machine, you will not enter it here. That capital expenditure is a different head altogether. It will be recorded, but it will be not recorded in the income statement. This income statement or the profit and loss statement is entirely about your business activity. You set up the business for a particular reason. You wanted to manufacture goods and sell to the public. You wanted to, let's say, develop software and sell that software license to the public. What you are recording in the profit and loss account is only those things related to those sales and the expense that was incurred to produce whatever was sold. Is everyone clear on this?
Yes.
Yes, sir.
Okay. Now, let's look at this profit and loss account. So, sales, income side, 10 lakhs, cost of goods sold. Now, to prepare the goods which were sold, what was the cost of producing these goods? 6 lakhs. So, I am writing that here. What is the gross profit that I make? I make 4 lakhs. So, at the simplest level, gross profit is the simplest one. I am just taking sales. From the sales, I am minusing whatever was the cost of the goods that I sold. The cost of the goods that I sold will cover everything from the raw material to the factory overheads, to the amount paid to labor, to the amount paid for salaries. Most of that will come here at the factory level. Then I look at my operating expenses. So to run my factory, I paid rent of 50,000. My electricity bills were 10,000. I paid 60,000 as salaries and wages. Marketing expenses was 20,000. Interest expenses was 10,000 because I borrowed some money from a bank. Depreciation was 5,000 on the assets that I have. So this is the other thing to note. This expenditure here, this 5,000, as I've also mentioned in a previous class, this is not something which is an outflow. This is a book entry. This is an entry which I am making. What I am basically doing is I am reducing the actual value of my asset every year because it is becoming older. How am I reducing it? I am reducing it by taking this head depreciation and putting a value to the amount of asset which has gone down. So if I have a machine, it costs, let us say, 1 lakh, and I assume that this machine has a life of 5 years. That means every year I am going to reduce it by 20,000. Over 5 years, that entire 1 lakh is gone. Why? Because after 5 years, I may have to replace that machine. So this is one way of also creating a fund which can be used for replacing the asset. That is one. Then I have paid insurance. I have paid conveyance. So my total operating expenses are 1,61,000. Now note, my gross profit was 4 lakhs. All these necessary expenses which I have are 1,61,000. So the actual operating income that I have is 4 lakh minus 161. I am getting 239,000. So then non-operating income. Income that I have from an activity or an investment other than the business activity. So remember when we were looking at the balance sheet, we saw that they had invested some amount of money in a different company. So let's say now they are getting interest from that company of 51,000. This 51,000 is also an income, but it is an income which is not coming from the day-to-day operations of the business. It is coming from a different side. But since the capital of the business is being used to get this particular return, it is being shown as part of the profit and loss. So,
Sir,
yes.
Sir, can you
yes,
explain depreciation? Can you explain the concept of depreciation?
So depreciation basically is every asset that you have has a life. It will not go on indefinitely. If you have, let's say, a building, that building also has a life. It will, let's say, it has a longer life. So what I will do is, if I say that a building costs, let's say 20 lakhs, and it has a life of 20 years, then that means every year I will reduce the value of the building on my books by 1 lakh. So please don't think of it as being related to market value. This is only an accounting thing which is done so that I am able to basically reduce the value of my assets as they get older. Okay. If tomorrow I sell that building, if I sell that building tomorrow, then what will happen is that if I sell that building, what is going to happen is that I will large profit from the sale. So when I get that profit into my books as non-income in the case of a building. In the case of a machine, let's say that I buy a machine for 5 lakhs. I am saying that this machine has a, let's say, life of 5 years. Every year I will reduce the value of the machine by 1 lakh. See, Pareshji, if you don't do this, let us put it like this. Suppose you don't do this. After 5 years, that machine becomes useless. What will happen is, you will now have to replace the machine. So what happened to the old machine? It has become useless. Its value was 5 lakhs. You will have to, in 1 year, in your expenditure column, say 5 lakhs minus. That will affect your profit. So instead of doing that, you spread it out over the life of the machine. So that there is the profit also is, reduced proportionately. If you don't do any depreciation, then every time you replace the machine, your accounting entry for the old machine, which is now over, which is no longer producing anything, that has to be reduced. How will you reduce it? By showing it as an expenditure. Anything which is losing value in accounts, that has to be taken as an expenditure. Are you getting the point?
Yes, sir.
Pakka?
Are
you sure?
Got it, sir.
Okay. What I'll do is tomorrow. I'll show you through an example.
Right.
You will get a better. I'll show you through a accounting example. What will happen if you don't have depreciation?
Okay.
And why do we have depreciation? What are the benefits of depreciation? And what will happen if you don't have depreciation? I'll show you both. Then you will be able to accept it better. Let's take it that way. But one thing is clear, that when I have depreciation, I am not actually, there is no outflow of cash. All I am doing is, I am reducing my profit. Suppose I did not have this depreciation, Pareshji, out here. My profit would have been how much? You are getting a total profit now of 2,90,000. If this had not been there, this expense would have been 5,000 less.
Yes.
Then my profit would have been 5,000 more.
Yes.
So my profit would have been 295 if this 5,000 was not charged. Now let's say every year I don't charge. So every year what will happen is this profit will be a little higher. Then 1 year suddenly you find that that particular asset is useless. You have to replace assets from time to time.
Yes.
Hello.
At that point of time, yes, Paresh.
Sir, Praveen here. Sir. Paresh ji has a doubt in depreciation. You can tell him like a vehicle we are purchasing, then why the value is decreasing every year by year.
So I was doing the same thing with a machine. If you are taking vehicle, fine. Let's say that is also an asset that the company has. It is using the vehicle for a particular purpose. Let us say that it is using the vehicle, it's a car, and it is using that vehicle for the benefit of its senior officers. Now, when that vehicle becomes old, it will have to be replaced. Let's say you bought the vehicle for 3 lakhs, and you are saying that this particular vehicle has a life of 5 years. That means if I do not have depreciation, after 5 years, if I have to replace that vehicle, see, when you are replacing the vehicle, you have to pass an accounting entry. See, when you buy something, when you buy an asset, your entry is, let's say the name of the asset is vehicle. What is the entry that you are passing? You are saying that this vehicle is worth 3 lakhs. So in your let's say where you maintain your list of assets, you will say vehicle 3 lakhs. Correct? Now, if for 5 years you do not have any depreciation, after 5 years you want to replace this vehicle. At that time, what will you do? What will you do with this 3 lakhs, this entry? If the vehicle, you sell that vehicle, and you sell the vehicle, let us say only for 1 lakh, that 1 lakh will not adjust your 3 lakh entry. And in any case, that 1 lakh is treated as income. So this 3 lakhs, the only option you have is, you will have to show this 3 lakhs as an expenditure. So initially you have 3 lakhs value of vehicle, then you will say the entire value is gone minus 3 lakhs. So vehicle account is equal to 3 lakhs minus 3 lakhs is equal to 0. But if you show it as an expenditure, then your profit will also come down by 3 lakhs. Therefore, what you do is, you will spread that expenditure of 3 lakhs over the life of the vehicle. And since we are saying that the life of the vehicle is 5 years, we will reduce the vehicle value by 60,000 every year. See, Paresh ji, what I will do is, now, tomorrow I will show you the account of an asset. How an asset account is maintained, whether it is a machine, whether it is let's say a vehicle, whether it is software, even whether it is software. And there we will.
I just want to know because after a few years now, depreciation will become zero. Means value of that asset will become zero.
Yes, it will be zero. So instead of zero, you write 1 rupee. The rule is, as long as that vehicle is there or that machine is there, to make sure that you know that something is there, you will write rupee 1.
Okay.
Now, your next question is, when I sell it, it sells for let's say 1 lakh. What will happen? Is this your question?
Yeah. Right.
That 1 lakh will be shown as income. That 1 lakh will be shown as income. It will not be in the asset account. It will come here as non-operating income. At 1 lakh, whatever you get, that will come here. Suppose this 51,000 was the cost of some vehicle that you had sold. Here you will write cost of asset sold, sale of asset, 51,000. That will be part of your income, like that.
So ideally, if any machine or any vehicle is depreciating, means we are losing its value day by day, then we should have benefit in loans or interest rate, no?
Why?
Because the value of that particular machine is going to decrease, no, day by day.
But you are the only person using the machine. No? Why should anyone else give you any reduction? See, when you do, these are two separate transactions. Now you have taken a loan to buy a machine. Okay. Now the bank gave you a loan because it wanted to finance your machine. Now two accounts are created. One is the account of the machine. One is the loan account. Now, as far as the bank is concerned, they are only interested in the loan account part, where they will charge interest and expect you to repay. If you continue to repay, the bank is happy. That account will gradually get adjusted. The asset account is your headache. Nobody else is bothered about the asset. The asset side, you will take your, whatever the asset can give you, it will produce something for you. That will continue. But over a period of time, the asset will lose value. And to record that reduction in value, you have, in financial terms, you have to do it. And the only way to do it in financial terms is to write off a certain amount of the asset every year. So traditionally, what you do is, right in the beginning, you say that this machine, you assume a certain life. You say that ye 10 saal chalega. So on 10 saal, I will take the value, divide by 10, whatever I get, I will do. Or you say ye 3 saal chalega. In the case of, suppose I buy software. Software jo hai wo 3 saal hi chalega. Then wo hum 33% par I will depreciate in 3 years time. 3 years time mein that software is gone, a new version has come, I will buy that again, फिर से एक नया asset खड़ा हो जाएगा. Difference ये है कि in the case of software, it is an intangible asset. It does not have a physical shape, but it is equally competent to give you an income. वो कहाँ बदल रहा है? So basically, chalo, it's a very interesting discussion. We'll continue this tomorrow. Okay?
Okay.
Okay, ठीक है. We'll continue this tomorrow. I'm so happy you people are asking these questions and you're getting interested in this. Thank you for that. I'm really happy this is happening. Tomorrow I'll bring some accounts along also, and I'll project that so we can go forward from there. Thank you very much, everyone.
Meanwhile, I check on net. So the NAV of ETF is.
I'll check. You people.
I have already checked.
What does it come to?
It is 43 to 40, in the range of 43 to 45.
That's what I told you, that there is a slight difference there.
Yeah.
Now, to understand the difference, we will have to get into the accounts of these companies.
Right.
Why they are maybe the
Tomorrow we will have a
rates
discussion.
slightly different.
Let us discuss tomorrow, sir. I will also search.
Okay, fine.
Thank you.
Thank you, sir.